What I have for you today is an interesting case from Kenya on residence and piercing the corporate veil, which I received from one of our followers, for which I am very grateful. So here you can see the decision itself. It is from the Tax Appeals Tribunal at Nairobi, and it concerns Naivas Kenya Limited. Before we look further at the case, let's just look at Naivas itself and see what it is. I have this information from Wikipedia. Naivas Supermarket, often referred to simply as Naivas, is the largest supermarket chain in Kenya with 84 outlets as of June 22. So when you follow this case, put for yourself whatever is your largest supermarket chain in your country in your mind, just to get a perspective of the local gravity of this case. In July 2018, the company hired Andreas van Paleske as an advisor to assist the business with its strategy and operations. This accumulated in bringing African private equity firm Amethys on board for a minority stake. At the time, Naivas Limited maintained 47 stores in Kenya, and look, now they have 84, right? So that clearly has led to quite some growth. In February 2020, the Competition Authority of Kenya approved the acquisition of 30% of Naivas shareholding by the French equity firm Amethys Finance at an undisclosed sum. And we're actually talking about this acquisition because this is the subject of this case. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses. So if we look at what the court, the facts that were before the court, it said the Gakivava Family Investments, the GFI company, formerly known as Naivas Holdings Limited, is a family investment holding company incorporated in Mauritius in 2017. And Gakiva Family Investment owns Naivas International Limited, right? So we have the Gakiva family in Kenya holding GFI from 2017, and GFI holds NIL. And then the court goes on to describe Naivas International Limited was incorporated in Mauritius on 16 October 2015, and it owns Naivas Kenya Limited, right? And that is the defender in our tax case. So we've got Naivas Kenya Limited here. And then it says the Gakiva Family Investments, or GFI, has 2 additional directors present who serve as directors from the Trio Pro Administrators, TPEL, which is a management and trust company that acts as a management company in Mauritius. So we have 2 directors here at the GFI level. One would assume in the hope to help with tax residents. If we go further, you know, there are some questions to be raised. The first one is, who held Naivas Kenya Limited before it was transferred to NIL or to GFI? If it was the Gakiva family, you know, was a transfer of those shares from the Gakivava family to NIL/GFI, was that taxable, and did GFI get a step up in basis or not? And that, of course, raises also the question, how was the current taxable gain calculated since then? Again, was there a step up in basis, or was that first transaction somehow tax exempt with preservation of the original tax base or something like that? Some further facts on 4 December 2019, Amethys Retail in France acquired a 30% minority stake, as we already saw from Wikipedia. The deal finalized in March 2020 was priced at 5.2 billion Kenyan shillings, which comes to about 36 million US dollars. And then the respondent, which is the tax inspector in July 22, made a corporate tax assessment of around 30%, or 1.8 billion Kenyan shillings, or 12.4 million US dollars, and that included penalties and interest. But later in the case, you see that the Kenyan tax rate on capital gains is 30%. So most of this 1.8 billion was a tax on capital gains. And then, of course, you get Amethys France now holding 30% of NIL, which means that GFI sold 30% of its shares in NIL to Amethys. There was at no stage any direct transfer to Amethys from the shares of Naivas Kenya Limited, right? And then the court describes the issues at stake as follows. It says the tribunal is of the view that there are two issues. The first is whether the Gakivava Family Investments, or GFI, is a tax resident in Kenya, and if so, whether there is nexus between the transactions subject of the assessments and Naivas Kenya Limited. And you need to realize there's something very strange going on here, right? GFI sold the shares in Naivas Kenya, but it is Naivas Kenya which is taxed for the gain that GFI was making, right? So there's a bit of a difficulty here, and that difficulty is explained by the second issue, and that is whether Naivas Kenya Limited meets the specific requirements of appointment as a tax representative for GFI. So what the tax authority said is, we think that Naivas Kenya Limited represented GFI in the sales of Naivas Kenya Limited, or NIL, the shareholder of Naivas Kenya Limited, to the French company, and therefore we're going to tax Naivas Kenya Limited as the representative of GFI. So a large part of the case concerned this discussion, were they a representative, were they not a representative, could they be taxed if they weren't the owner of the Naiva shares and stuff like that, and to the extent relevant, because it's not really an international tax issue, it's more a local law issue. But here is what the local law says. Section 15.1.1 of the Tax Procedures Act say a person is a tax representative of another person for the purpose of this act or a tax law. In the case of a non-resident person, if that person is controlling the non-resident person's affairs in Kenya. So in other words, Naivas must have controlled GFI's affairs in Kenya, including being a manager of a business of that non-resident person, right? And then section 2 says where a person required to appoint a tax resident in accordance with subsection 1 fails to do so. In other words, GFI should have appointed a tax representative in Kenya. The commissioner or the tax inspector may appoint a tax representative for that person, and that's what happened here. The tax authority said, you, Naivas Kenya Limited, are the tax representative of GFI, and therefore we will tax you for the gain realized by GFI. And section 16.1 says a tax representative of a taxpayer shall be responsible for performing any duty or obligation imposed by tax law on the taxpayer. So this is what Naivas should have done, including the submission of returns and the payment of tax. And that's why Naivas gets taxed, because it should now pay the tax that GFI should have paid, right? I don't want to spend a lot more time on the tax representative issue. I think the more interesting international question is the residence. But the last point that the court makes, it says for one to fall under our section 15.1.1, it must be a person that controls the affairs of a non-resident person's affairs in Kenya. It means Naivas would have to be in control of GFI's affairs, and the court concludes that that is the case. Now, when it comes to the residents, the court starts by saying for management control, the main aspect considered is the key people managing the company, which implies that shareholding is different from management. And the court and the tax inspector makes quite a issue of, shareholding and management is different. And we'll look into that a little later. But for now, let's just stick to the classic residence. And paragraph 104 of the decision says, according to the minutes of a meeting held on 18/3/2020, only the Kenyan directors can initiate and authorize transactions of the bank accounts in Mauritius. This confirms that the financial management is done from Kenya, right? So we have these two Mauritians as directors of GFI, but they really don't have any real power, is what the court says, because the real power is with Kenyan residents. In the tribunal's view, this therefore buttresses the fact that GFI and NIL are managed and controlled in Kenya, and thus this is a confirmation that they are tax residents in Kenya. And then they go and quote an impressive list of UK cases on tax residents. And I must say I'm really impressed by both the cases brought forward by the tax authorities, by the taxpayer, and by the court. It really has an international look on issues such as residence. It starts also by saying, we need to look at management control. We need to find what definitions there are, and we look to UK courts and to some Kenyan cases in this as well. But the cases they quote is Leerstad BV, which ended up unsolved because the taxpayers settled out of court. But the court clearly said that they thought that the BV was resident in the UK. The Beers Consolidated Mine, a very, very old case from 1906, which said that the Beers was resident in the UK, not in South Africa, where it had its diamond mines, because it was not about mining for diamonds, it was about selling diamonds, and that happened in the UK. Then Bollock versus Unit Construction Company and Union Corporation versus Commission of Inland Revenue, two very old classic UK cases on tax residents as well. And then later in the decision, after the court has discussed these decisions, it says an independent entity test carried out to determine the nature of the operations of GFI and NKL, so that is Naivas Kenya Limited. The operation in Mauritius had limited or no activities, nor tangible structures demonstrating a going concern. So there was nothing in Mauritius besides the trust company presence, right? It is not possible to attribute the returns of the operations relating to an entity that does not demonstrate reasonable cause of existence, thus leading to the tax inspector carrying out a tax assessment on Naivas Kenya Limited, where the substance of the transactions with a tax implication lie. Now again, there's a specific Kenyan angle here, but they basically say, GFI and NIL are nothings, and we are piercing the corporate veil, and we look right through them, right? So now we're taxing Naivas for the gain on the sale of the shares. And the court concludes from the foregoing, it is therefore clear that GFI is managed and controlled from Kenya, and that makes GFI a resident for tax purposes of Kenya and therefore subject to tax in Kenya on the capital gain, right? Some further facts that was brought forward by the tax inspection, which I think are interesting, because it enforces the tax residence of NIL and GFI in Kenya, was the directors were David Kamini Mukuha, I should say. All four are tax residents of Kenya. I assume they were also directors of Naivas. The GFI directors, the court says, are Kenyans and tax resident in Kenya. That the inquiry is not from GFI, from where GFI is controlled from, but as to where the business of GFI is controlled from. So we get this point on the difference between ownership and running the business again. And then some of the tax inspector's argument was corporate residence is related to central management control of business, which is exercised by the directors and not by control of the company itself, which is exercised by the shareholders. And then they quote this interesting, I think it's a UK case from 1908. I will discuss that at some point if I can find it. But you can see this whole issue of it's not the role of the shareholder, but the role of the directors was brought by the tax authorities themselves as well, and it must be a pretty important point under Kenyan law and in general, but one just doesn't see this being so accentuated so often, right? And then paragraph 62 lists the tax inspector's arguments as to why he thinks this company was resident in Kenya. It says the inquiry is not from where GFI is controlled from, but as to where the business is controlled. To achieve this, the respondent relied on various aspects about the company. First, the directors and their actions. The majority of their directors are Kenyans and tax residents in Kenya. Knowledge of the Naiva Limited business, that the Kenyan directors are knowledgeable and significant to the business, and that is clear. I mean, the trust office can never know the same amount about the business as the local business owners and directors can. Records on administrative matters, that documents have gaps. For instance, there are no accurate minutes of each board meeting. This is just sloppiness, but obviously it will reflect on the strength of your case. The nominee services, there's no real evidence that TPEL directors are paid for any real work. The inspector sounds very cynical here. I don't know whether there were any payments made, but I've seen many multinationals where they do try to pay the trust company as little as possible, and the trust companies compete with each other on price, only making everything worse. And then the meetings, there no evidence apart from Mercy Waitera's travel to Mauritius in 2018, but the sale was in 20. Most of the meetings were virtual, and that of course is also a cost-cutting measure which hurts the residents of the Mauritian companies. Assets in Mauritius, no evidence that NIL GFI had employees or assets in Mauritius. I think a lot of European countries and other OECD countries would also say, you know, you have no one there. Do you really expect us to assume that you are resident in Mauritius? So that is the facts as presented by the court and the tax inspector, and it leaves us with a number of questions. And for me, the first one is, this is an interesting case on the variation of taxing indirect capital gains, right? I mean, this case has something in common with Vodafone and some of the Indian cases and Chinese cases on the indirect taxation of capital gains, where they say, you know, the companies in between doing the sales and involved in this transaction have no substance. What you're really selling is an Indian asset, or in this particular case, you're selling a Kenyan asset. To the taxpayers' lawyers bring up some interesting issues which were more discussed under Kenyan law, but they did raise an issue about undisturbed enjoyment of property under the Kenyan constitution, if I understand correctly. And basically what they said was, you know, Naivas had no access to GFI's assets and profits, so how could it pay the tax for GFI? Of course, that is solved by piercing the corporate veil, but it could also have been a case about human rights. I think Naivas probably may have a issue of public perception. You know, supermarkets are some of the businesses which are most exposed to what the ordinary taxpayers of a country are thinking. And I know, for instance, in Holland, large supermarket chains are quite concerned about their public image as good corporate taxpayers, because if they are not good corporate taxpayers, they fear that they may lose customers who are personal taxpayers. The size of the capital gain remains a mystery, because we don't know if this gain of 5 billion shilling rose from the moment that the shares of Kenya Naivas was transferred to NIL, or whether it was from before that time. And then the other question was, you know, did they really need to pierce the corporate veil? Because once you've established that the GFI was resident in Kenya, you could just tax it as a resident of Kenya. Why did you have to pierce the corporate veil? I'm not quite sure whether there are local specific Kenyan reasons for doing this, but I thought that was overdoing things a bit. And then, of course, it's very interesting that there is no treaty reference on Article 4 on the Kenyan-Mauritian Treaty on what it says about residence and about management and control and about treaty interpretation. And then we'll get to that in a moment. But then the last point I want to raise here is, I also find it interesting, you know, if you are going to pierce the corporate veil and you're going to say, I'm going to ignore GFI and NIL, then shouldn't you tax the shareholders behind GFI and NIL? So shouldn't you have taxed the family maybe directly instead of taxing Naivas? I'm not quite sure. Again, maybe there are specific Kenyan reasons for not doing this, but I would have said, you know, when you are going to rip through the corporate veil, one would look up instead of down, unless, of course, you have this concept in your law of a tax representative, which the tax authorities decided to use in this case. One last point about the Kenya-Mauritian Treaty, because one may wonder, why didn't they look at the treaty at all? And the answer is, there is no treaty. If you look at the PwC tax alert here, the double tax treaty with Kenya and Mauritius was signed on 10 April 2019 and ratified by Kenya on 30 June 2020, but it doesn't say anything about Mauritius having ratified the treaty yet, right? The signing and ratification of the new treaty follows the invalidation of the previous treaty between Kenya and Mauritius by the Kenyan High Court on the basis of legal notice 59/2014, publishing the old treaty had not been presented before the Kenyan Parliament. So there was a treaty in place. This one got declared null and void by the Kenyan High Court because there was no, it has not been presented to the Kenyan Parliament. Then they renegotiated a new treaty which was signed in 2019, ratified by Kenya in 2020, but not ratified by Mauritius yet. So there was no treaty. But if you look at the treaty, the 2019 treaty, it has a 2014, I should say, style resident article. It says Paragraph 3 of Article 4, where by reason of provision of paragraph 1, a person other than an individual, in other words a company, is resident of both contracting states, then it shall be deemed to be a resident only of the state in which its place of effective management is situated. So under that treaty, it would have been fine to look at effective management. You wouldn't have to defer to the competent authorities as you would under the 2017 and the post-BEPS Model Convention. And then for the purpose of paragraph 3 of this article, the term place of effective management means the place where strategic and commercial decisions that are necessary for the conduct of an entity's business as whole are in substance made. So the definition is locked into the treaty, narrowing the development space under case law for that. But even if the treaty was in place, it would not have helped Naivas, because if you look at Article 13 on capital gains, it has an interesting add-on. And it says gains other than those to which paragraph 4 applies. So this is, real estate companies derived by a resident of a contracting state. So gains derived by a resident of, let's say, Mauritius, from the alienation of shares of a company which is a resident of Kenya, may be taxed in Kenya if the alienator at any time during the 12-month period preceding such alienation held directly or indirectly at least 50% of the capital of that company. So because GFI held 100% of the shares in Naivas Kenya and then sold 30% to the French investment firm, that gain would have been taxable under the unratified treaty in Kenya, even if there was a treaty, right? So that would not have helped the taxpayer either. I hope you enjoyed this case. I think it was an interesting one. I like it when we can do cases from other countries besides the usual culprits, US and Europe and India and those. I think it brings up some interesting points, and since we're not only doing business in Europe and India and the US, it is also good to know what's going on in other countries. I look forward to discussing another case with you next week. Bye for now.